Hi, today we are going to discuss regarding AS 19 leases. Okay, so before going into the topic, in a layman language, what is a lease? So, in a layman language, what is a lease? Like normally, if any asset, let's say there is a building, now there is an owner and there is a tenant. So, the agreement between these two parties we call it is an lease. So if you go to in technical terms, so what is an lease? So lease is an agreement in which the lessor conveys to the lessee, right to use an asset in return for payment or series of periodic payment over agreed period of time. So what is an lease? An lease is an agreement in which the lessor conveys to the lessee the right to use an asset in return for payment or series of periodic payment. If we compare the definition with the example we have taken, so here there are two parties, owner and tenant. So who is a lessor? The lessor is the owner. So who is the lessee? In a layman language we call him as a tenant. Now the owner means the lessor has given the lessee the right to use an asset. If we compare to our example, what is an asset? We have taken an example, it's a building. So the owner has given the right to use an asset, to use a building to lessee. Why he has given a right to use an asset to the lessee? In return for payment. The lessee will pay to the lessor the amount, the lease amount or rent amount on some periodic basis. To that amount, the owner, the lessor has given the right to use an asset to the lessee. So if we summarize the definition, the lease is an agreement or contract in which the lessor, the owner, gives the right to use an asset to the lessee, means the tenant, in return for payment or series of periodic payment over the agreed period of time, means any period which is agreed between lessor or lessee. Now if you go to AS 19, the AS 19 leases, it's not applicable to all leases. So the AS 19 says, if you discuss on applicability, it says it's applicable to all leases except lease agreement for explore or use of natural resources. So any lease agreement where the agreement is for use or explore of natural resources. So natural resources like example coal, iron ore, etc. So an agreement, any lease agreement for use of these natural resources, coal, iron ore, etc., then the AS 19 is not applicable. Another exception is any license agreements. So license agreements means like example any movie picture license or any video recording license or any patents or copyrights, like any patent to the book or any rights to use a movie or video recordings. To that license agreements also AS 19 is not applicable. And third is use of land. So any agreement, lease agreement for use of only land, also AS 19 is not applicable. Now next we go to the types of leases. So in AS 19 there are two types of leases. One is finance lease, another one is operating lease. Okay, now what is finance lease? So it says that any lease agreement wherein which transfers substantially risk and reward to lessee. So a lease agreement where the agreement transfers substantially the risk and rewards to lessee, then it is called a finance lease. If it is not, then it is an operating lease. So operating lease, simply it says other than finance lease. So what is a finance lease? The finance lease means a lease agreement wherein which it transfers substantially the risk and rewards to lessee. In operating lease, it do not transfers risk and reward substantially to lessee. So substantially means in AS 19 they do not describe what is substantially. It's a judgmental thing. We have some factors which determines us what is a finance lease or not. So we have some factors. So there are some factors which determines what is a finance lease. Like let's say like one of the factor is transfer of ownership at end of lease. Now if there is a lease agreement in which the asset, so what is the right we have to use that asset, if the asset ownership get transfers at end of the lease, then it is a finance lease. Why we call it a finance lease? Because if the ownership is getting transferred at end of the period, that means your risk and rewards which is associated with the asset which is getting substantially transferred. So that is the reason we say any transfer of ownership and end of lease, we call it as a finance lease. Another factor which says option to purchase an asset at end of lease period, wherein which the purchase price should be less than fair value. So another factor is if in the lease agreement there is an option. What is an option? The option to purchase an asset. So let's take we take an example. Now there is a building lease agreement. So there is a lease agreement for building A. So it is between two parties. One is owner, another one is tenant. Let's say so owner will be called lessor, tenant will be called lessee. Now it is for a period of 5 years. Now in the lease agreement it says that at the end of 5 years the tenant means the lessee can purchase the building at a price, at a purchase price which is less than the fair value at the date of exercise. Then we can say it as a finance lease, because the what in the finance lease we says that if the risk and rewards are substantially transferred to lessee, we say it's a finance lease. In this case also, since the lessee is getting the option to purchase, and this option should also be exercisable at inception of lease. Inception of lease means at the lease start date. And another third factor which says the lease term. So lease term means lease period, the period to which the lease agreement has been entered, the lease period which covers substantially economic life of the asset. Let's take the same example. The economic life of the building is, let's say it is 30 years. Okay, and the lease agreement they have entered for the building, let's say it is 25 years. So in this example, the lease agreement is for 25 years. The life of this building is 30 years. So the lease period which is covering the majority of the economic life. So means majority means the substantial portion of the economic life is covered by lease period. Hence this is also the finance lease. Another factor where the minimum lease payments, which covers substantially or majority of the fair value of an asset. In the same example, if we say in the building, the fair value of building, let's say it is 40 lakhs. Okay, so the fair value of the building is 40 lakhs. Now the sum of lease payments, let's say the lease agreement is for 10 years and yearly lease payment is it's like 3.5 lakhs yearly lease agreement. So if you see here, the total lease payments are coming how much? 35 lakhs. If you compare with the fair value, so the majority of the fair value was covered by lease payments. So in this, if we compare the example, the minimum lease payments means the total lease payments 35 lakhs. If you compare with the fair value means 40 lakhs, it is covering majority of the fair value. So the sum of lease payments 35 lakhs, which is majority of the 40 lakhs is covered by here. So this also we say it's a finance lease. Another case, an lease agreement where the lessee has made specific modification. Let's take one example. Same example. So there is a building. In the what happened here? So there is a lease agreement, lessor and lessee. Here in this building they made some specific modification. So they made some specific modification such that this building cannot be used by other tenant. So the fifth factor which says that an asset and leased asset which cannot be used by other lessee without any significant modification, then also we say it as a finance lease. Except lessee, no one can use it without significant modification. So if we compare this with example, so here the building lease agreement, the lessee has made some modifications. Maybe he changed the rooms, he invested some amount on furniture, so he made some modification on this furniture. So this building cannot be used by other tenants. So it can be used by only this tenant without any significant modification. So this case also we say it as a finance lease. So if we compare here, if we summarize what is finance lease, what is operating lease. So we says finance lease means simply we says it as an agreement where the substantial risk and rewards are transferred to lessee. So substantial risk and rewards means it's like control. Majority of the control if it is transferring to lessee, then it's a finance lease. So these are the factors where we can say if this factor, any of these factors are covered, then it is a finance lease. So operating lease, it is very straightforward. So we'll study what is the accounting treatment in the books of lessee, in the books of lessor. So in operating lease, what the accounting treatment is? So the lease amount or rent amount. So whatever the lease amount is there in lessee books, what we do, we recognize in P&L. We recognize it as expense in profit and loss statement. Here it is an income to lessor. The lease amount will be expense to lessee, so we will recognize the expense in profit and loss. Here we will recognize the income in profit and loss. But the condition is we recognize this expense on straight line basis. Here also we recognize the income on straight line basis. Let's take one example. So for year 1 the lease payment is 10,000. For year 2 the lease payment is 20,000. For year 3 the lease payment is 30,000. So in year 1 the expense in the books of lessee will be not 10,000. How much it will be? We will take on straight line basis. So we need to sum of all these things, 60,000 total lease payments divided by number of years. So it will be 20,000. So in year 1 the amount expense we recognize in the books of lessee is 20,000, not 10,000, because we need to recognize it on straight line basis. So we will recognize 20,000. Same in case of lessor also, the income we should recognize in books of lessor is 20,000, not 10,000. So if we go to the entry in books of lessee, we will make payment to lessor. So bank will be credited to bank account. So in year 1 as per the example we pay 10,000, but expense we should recognize is 20,000. So the difference with whatever the amount is there, that we transfer it to lease equalization reserve account 10,000. If we come to same case in the lessor also, for lessor the lease amount will be getting. So the bank account will be debited. So we debit how much? 10,000. But the income we recognize on straight line basis. So the lease income will be credited. How much? 20,000. So the difference here also we transfer it to lease equalization reserve account, 10,000. So going on year, the lease reserve account will be nullified to 0. If you come to finance lease, so in the finance lease, from the point of in the books of lessee, in the books of lessor. So first we come to lessee. So in the books of lessee, we recognized an asset and also an liability. Why we recognize an asset and liability? Because it is a finance lease. In the finance lease, lessee is getting substantial portion of risk and rewards, means he is getting majority of the control. Since he is getting majority of the control, he should recognize an asset and liability. What is the amount at which we recognize asset or liability? Which is equals to lower of minimum lease payment or fair value. So at the lower of minimum lease payment or fair value, whichever is lower, that amount will recognize an asset in the books of lessee, same amount will recognize as a liability. So what is here minimum lease payment? The minimum lease payment means it's a sum of present value of lease payments. Lease payment means the monthly lease amount plus guaranteed residual value by lessee, means sum of present value of lease payment. So whatever the monthly or yearly lease payments are there, that is the sum of those values plus the guaranteed residual value by lessee. So in agreement, in the lease agreement, if a lessee says that he gives some guarantee, so whatever the residual value get at end of the lease period, if he assures that he will pay this much amount, minimum guarantee amount, so we'll take that guarantee amount also. Let's take one example. So there is a building lease agreement. The yearly lease payment is, let's say, 10 lakhs. Okay, it is for period of 5 years. Now in this building lease agreement, the lessee has guaranteed that he will give residual value of 5 lakhs. Means the end of the 5 years, lessee will pay extra 5 lakhs amount to owner, means the lessor. Means he is guaranteed that this much amount of the residual value. So for getting minimum lease payment, what we do present value of 10 lakhs for 5 years plus 5 lakhs at the end of 5 years. Then you will get minimum lease payment. Then we compare this minimum lease payment with the fair value. Now here, for example, if we got minimum lease payment of 45 lakhs, but the fair value is 50 lakhs, we compare whichever is lower. So we recognize asset and liability at 45 lakhs. If the fair value is 40 lakhs, so whichever is lower, then we recognize asset at 40 lakhs and liability at 40 lakhs. If we come to lessor, for the lessor, we recognize an asset, means it's a lease receivable at net investment in lease. So in the lessor, the asset will be recognized at net investment in. So what is net investment in lease? So whatever the value we get here, so net investment lease like minimum lease payments plus unguaranteed residual value. So it both will be same, but the difference is due to unguaranteed residual value. So what is unguaranteed residual value? So whatever the residual value you get at end of the lease period minus the residual value guaranteed by lessee. The whatever the balance you get, that is unguaranteed residual value. Let's take one example. Now the expected residual value at end of the lease is, let's say, 10 lakhs. Now lessee has guaranteed, the guaranteed residual value done by lessee is, let's say, 6 lakhs. Then the unguaranteed residual value will be 4 lakhs. So this 6 lakhs is guaranteed residual value, this 4 lakhs is unguaranteed residual value. So if you combine minimum lease payment plus unguaranteed residual value, you get net investment in lease. In lessor, the asset will be recognized at net investment lease by de-recognizing that asset. So if you go to take one example, building. Now lessor has given this building on lease. Now what we'll do, we will de-recognize this building and recognize net investment in lease. So this is the initial recognition. So in a lessee books, So first the lease is recognized at lower of MLP, minimum lease payment or fair value. Here in lessor books, first lessor will de-recognize his asset, then he recognize lease receivable at net investment in lease. So whatever the difference between both is, here it will be present value of lease payment plus guaranteed residual value. Here minimum lease payment plus and unguaranteed residual value. So unguaranteed residual value is the difference between both. Here what we'll do, next subsequent recognition. In the lease what we do, here we recognize depreciation. So depreciation we recognize on asset. So whatever the asset here we are recognizing, on this asset we recognize depreciation. Here with respect to depreciation we need to take as per AS 16 whatever the life they determine as per AS 16. In accordance with that life we need to recognize the depreciation of the asset. Next we will recognize interest expense. So on the liability part, so in the lessee we recognize one asset and also we recognize one liability. So on asset will be depreciated and here the liability will be, here we will recognize finance charges or interest expenses. Here when you come to lessor, so once we recognize net investment in lease, then here we will recognize interest income in subsequent years, and whatever the lease amount we get, that we adjusted to this amount. So this is it, accounting treatment for finance lease in books of lessee and in the books of lessor. We say it's a law. Why we say law? The audit is interrelated to law. Why? Because when you're doing an auditing of any company or any entity, before understanding, without understanding of law, you cannot properly verify the financial information. Let's take for example of taxes. Without knowledge of income taxes, without knowledge of income tax provisions, indirect tax provisions, you cannot know, you cannot calculate the tax liability properly. So what we say, to do an auditing, you should also have the knowledge of law, because due to non-compliance of laws and regulations also, which can make the company to close, there can be a huge penalty from the government as well. So that is the reason we say for auditing an entity, you should also have the knowledge of law. That is the reason we say it's an auditing is interdependent to law also. And another discipline, another subject, we say maths and stats. We say that audit is also interdependent to maths and stats also. Why? Because with respect to financial information, when you are auditing, you should normally perform the ratio analysis, financial performance of the company, where you will go through the stats of the previous period or future period, where you will use some mathematical formulas or statistical methods. So to go to that, you should have understanding of basics, maths and stats. That is the reason in foundation also we have the subject of maths and stats, just to give you the understanding. And we also says you should also have the knowledge of financial management. So what is financial management? Means the managing the financial operations of an entity. So when you are doing an audit of an entity, you should also have the understanding of how that entity is operating, how they are getting the money, whether they are getting the money through an owners or they are getting from the banks or financial institutions. So you should also understand that, and also you do some ratio analysis also for in the financial management also. So that is the reason you should also have the knowledge of financial management. And also we says you should also have the knowledge of economics and production, because any entity operates through economics only. So any business or any company, they operate their business through an economics only. So when you are auditing an entity, you should know what is the business of the entity, how they are, what is their product, what is their service, how they are getting their raw material, what is the demand and supply of an entity. So to understand all those things, you should have the understanding of economics. So that is also the reason in CA Foundation we have the syllabus of economics also. And another last we say behavioral science. So why behavioral science is related here? Because when you are doing an auditing an entity, you will be interacting with the top management, CEO, CFO. So you are interacting with many people. So you should behave professionally with them. So that is the reason when you are doing an auditing, it is also related to behavior. So how you are behaving. So that is the reason we say audit is an interdiscipline. Why? Because it is related to many subjects like accounting, law, maths, financial management, economics and behavioral science. Now we have understood what is an auditing, we also know what is the nature of an auditing, but why we are doing an auditing, like what is the objective of doing an auditing, like what is the purpose. So if we see the definition, auditing, what we say it's an examination, independent examination of financial information. But why we are verifying the financial information? So what is our purpose? Why we are checking the financial information, or why we are checking the financial statement? What is our purpose? We say, so what is the purpose? We say to obtain reasonable assurance on financial statement. So what we are saying, to obtain reasonable assurance on financial statement, whether they are prepared. So what we say, what is the purpose of doing an audit? We say why we are doing an audit, because to obtain reasonable assurance. So what is an assurance? Assurance means like confident. Like when you are checking something, you should be confident. So here also, when you are checking the financial information, you should be confident that the financial statements are not materially misstatement, means there is no wrong in the financial statements. So you should be confident. But here we say it should be reasonable confident. Means reasonable confident means I'm sure, like I'm confident that there are no misstatements, but I'm not 100% sure. We say reasonable assurance means it's not absolute assurance. Absolute assurance means it's an 100% confident. Reasonable assurance means less than 100%. Means I'm confident that there are no misstatements, but I'm not 100% confident. Why I'm not saying 100% confident? Because there are some limitations in auditing. There are some limitations in auditing, like maybe due to timelines, or maybe due to nature of audit, or maybe due to nature of accounting. So due to these reasons, I cannot obtain 100% confident. Normally in fraud investigations or in police investigations only we will be getting 100% confident, but in the auditing, due to some limitations, we cannot get 100% confident, but it is less than 100%. So that is the reason we say it's a reasonable assurance. So what we are obtaining, the financial statements are, why I am getting this confident? Because to enable, means to express an opinion, that the financial statements are not, that the financial statements are prepared in accordance with the applicable financial reporting framework. So what is the confidence I am getting here? That the financial statements are not materially misstated. Why I am getting the confidence? Because to express an opinion. So opinion means that the financial statements are correct or wrong. So that is an opinion. So to express an opinion that the financial statements are prepared in accordance with the applicable financial reporting framework. So applicable financial reporting framework means the AS or Ind AS, which is applicable to entity. So whatever the financial reporting framework which is applicable to entity, so that we call it as applicable financial reporting framework. Like example, we can take as AS or Ind AS or IFRS. So this is the objective. And why we are doing all these things? To report on financial statements. So once we express the opinion, to whom we are giving this opinion, the report on the financial statements this will be given to members. So this is the objective of the auditing. In the technical terms, so what auditing, we say it's like examination of financial information of an entity. So if you see in our example, what I did, I verify the bill with the physical item. So here also same. In auditing also what we do an examination. So examination means like checking, watching, verification, inspections. So examination of financial information. So the financial information means like financial statements or any special purpose financials. So any financial information of an entity. So we say it's an entity. So entity means it can be sole proprietorship, or it can be a company, or it can be a partnership firm, okay, or it can be also an NPO, non-profit organization. So in the definition they says that an auditing is an examination of financial information of an entity. So what is an entity? An entity can be profit oriented or not profit oriented. It can be profit oriented or not, or irrespective of size or legal form. So if we see an example, we take it as a sole proprietor or NPO also. So in the definition also they says an entity means whether it can be profit oriented or not profit oriented, or irrespective of size, whether it is big company, whether it is small company. So if we compare here sole proprietorship company or partnership, irrespective of its legal form also. So legal form means proprietorship, company or partnership. But the examination we cover here, it should be an independent examination. So what is an independent examination? So independent examination means whatever the checking, whatever the verification, whatever the watching you are doing, it should not get influenced by the third party. So it should not influence. So it should not get influenced by the person who has appointed you. So you should not get influenced by the entity. So the examination we say it's an independent examination. So what is an auditing? So auditing means it's an independent examination of financial information of an entity, whether it is profit oriented or not, or irrespective of its size or legal form. But whatever the examination you done here, it should be, you should express an opinion. So what is an opinion? Means whether it is correct or wrong, whether it is true or like whether it is incorrect or correct. So you should express an opinion. Then only we call it as an auditing. If you see my example, the example which I have taken is like I do a shopping. So what I did, I compared bill with the physical quantity. So here also I am doing an examination. Okay, but this is not independent because I am checking for my bill. So it is not independent. So independent means you should be not influenced by other person. So if we summarize the definition of auditing, we say it's an independent examination. Means independent means you should not get influenced by others. Examination means checking, verification or inspection or anything of financial information. So financial information means it can be financial statements like balance sheet, P&L, cash flow, or can be some other any specific information, financial information also of an entity. Means any entity, whether it can be profit or it can be non-profit, or it can be irrespective of its size, whether it's a big company or small company, irrespective of its legal form, whether it's for a sole proprietor, partnership or company, charitable trust, anything. But whatever the examination you done here, you should express an opinion. Then only it comes the definition of an auditing. Here, audit nature, if you go to nature of an auditing, we say audit is an interdisciplinary. So we say the nature of audit is interdisciplinary nature. So disciplinary means subject or knowledge. So it says that interdisciplinary nature means inter-knowledge. Means if you are doing an auditing, you should have an understanding or knowledge of various subjects or various disciplines. Like let's say accounting. So auditing is dependent on accounting, because if you see the definition, what we say it's an examination of financial information. So if you want to verify the financial information, first of all you should know how the financial information is prepared, how books of accounts are prepared. Then to do an auditing, then you should have the knowledge of accounting. So that is without the knowledge of accounting you cannot do the audit. So that is the reason also in our CA syllabus or syllabus also you see we have the subject of accounting.